Have you ever stared at a stock ticker and just wondered, what's actually going on behind those flashing numbers? In that silent, invisible world where prices are actually born? Well, it's a high-speed battleground, and it's run almost entirely by algorithms. Today, we're going to pull back the curtain and go inside the machine.
All right, let's dive in. Here's our game plan for today. We're going to peel back the layers of this thing one by one. We'll start in the digital arena where all the action happens, and we're going to build all the way up to the AI-powered robots making the final calls.
So, our first stop on this journey is right in the heart of modern finance. It's basically a giant database called the Limit Order Book, or LOB for short. And this is it. This is the place where every single intention to buy or sell a stock gets logged.
Now, I know this quote sounds a little academic, but it really gets to the core of what's happening. The LOB isn't just some boring list. You got to think of it as the market's collective consciousness, a living, breathing database of pure supply and demand that's getting updated millions of times a second.
So how did we even get here? Well, it wasn't always like this. Markets used to be run by human specialists yelling at each other in trading pits. If you wanted to trade, you had to go through them. But today, we live in this order-driven world where pretty much anyone can post an order directly to the book. It's way more democratic, it's more transparent, and it is unbelievably fast.
And this is what it looks like. This table really lays out the architecture of the market. You've got the ask side up top. Those are all the people who want to sell. And then you've got the bid side on the bottom. Those are the people who want to buy. The best prices, you'll notice, are right there in the middle. And that tiny little gap between them, that's the spread. And that's the fundamental cost of making a trade right this second.
Okay, so this brings up a really important question. If you have a bunch of people all willing to buy at the exact same best price, who gets the trade? How does the system decide who's first in line?
And the answer is a rule that is both simple and absolutely ruthless. It's called price-time priority. First, the best price wins. No surprise there. But for everyone at that same price, it is strictly first in, first out. FIFO. It's just like a line at the grocery store. You get there first, you get served first. And this is why you hear about firms spending millions of dollars just to shave a few microseconds off their connection time. It's all about getting to the front of that line.
So let's just walk through it. Your order arrives, and boom, it goes to the back of the line. It sits there and waits. And only when every single share from every single order that got there before you has been bought or sold, does your order finally get its chance at the front of the queue. Your place in that line? It's everything. So if we know the best price to buy and the best price to sell, then the true price of the stock has to be just smack dab in the middle of that spread, right? Well, you'd think so, but it's actually not that simple at all. Most people look at what's called the mid-price. It's super easy to calculate, you just average the two. But it has one giant, massive blind spot. It completely ignores the volume of orders on either side.
And this right here is the million-dollar question. I mean, think about it. If you have a massive wall of people wanting to buy and only one tiny little order on the sell side, is the geometric middle really telling you the whole story? Of course not. The real story of supply and demand is in the volume, and the mid-price is totally blind to it.
So to fix this, quants use a metric called order book imbalance, or OBI. By looking at the ratio of buy volume to sell volume, it gives a much clearer signal of the real pressure in the market. And research shows it gives a much better clue about where the price is likely to head in the next few seconds.
And you can really see the evolution of this idea right here. We started with the simple mid-price, then we got the weighted mid-price, which was a step up, but it had this technical problem. It wasn't what they call a martingale, which basically means it had a predictable drift that could be exploited. So now, the state-of-the-art is something called the micro-price, which is the sophisticated model that actually calculates the probability of the next price move to filter out all the noise and find the real underlying value.
Okay, so everything we've talked about so far is trying to find the true price right now. But what if you could predict where the price is going before it even moves? Well, that's where AI comes in. We're talking about systems that scan the entire order book, looking for patterns that no human could ever possibly see.
The leading model in this space is called Deep LOB, and the way it works is just fascinating. First, it uses a type of AI that's great at image recognition to take a snapshot of the order book and find patterns in its shape. Then, it feeds that snapshot into another type of AI that's really good at understanding sequences, like what's used in language translation, to find patterns in how those shapes are changing over time. It's literally reading the market's story as it unfolds, frame by frame.
And the results? They are just staggering. I mean, look at that number. To achieve this level of predictive accuracy on tiny short-term price moves using only public data from the order book, that's something that was considered pretty much impossible just a few years ago.
Okay, so you've got this AI model that's like a crystal ball. It's giving you these incredibly powerful predictions. The price is about to go up. So, what now? How do you actually make money on that without taking on a crazy amount of risk? This brings us to the final piece of our puzzle, the automated market-making algorithm.
A market maker's basic job is to post both a buy order and a sell order, and its goal is to make a tiny profit by capturing that spread in the middle. When its inventory is zero, meaning it hasn't bought or sold anything yet, it just posts its quotes evenly on both sides of the market. Nice and simple.
But, what happens when someone comes along and accepts its offer to buy? It now owns 1,000 shares. And this is a huge deal. It's called inventory risk, because if the price of that stock suddenly tanks, the algorithm is sitting on a big, fat potential loss. It needs to unload those shares, and it needs to do it fast.
And here is the really clever part. The algorithm skews its quotes. To get rid of those 1,000 shares, it makes its sell price more attractive by lowering it just a bit. But at the same time, it makes its buy price less attractive to discourage anyone from selling to it and adding to its problem. It's this dynamic, automated risk management all happening in microseconds.
But the most advanced strategies? Well, they take this one giant leap further. Instead of just reacting to what's in their inventory, they use that AI price prediction as their guide. So if the deep lob model predicts the price is about to drop, the algorithm starts skewing its quotes to sell before the drop even happens. It's basically getting out of the way of a speeding train before it even leaves the station.
So we've gone from a simple list of buy and sell orders, all the way through the physics of the queue, to AI that can practically read the market's mind, and finally to robots that manage their own risk automatically. And it leaves us with this one critical question for the future. As these incredibly smart, incredibly fast algorithms become the market, are they making it more stable and efficient, or are they just making it faster and a lot more fragile?